Good morning, traders. Welcome to FreeFX. Today is Thursday, the 7th of January 2016. First of all, Happy New Year to you all. This is my first video of 2016. Today we're going to discuss a number of things. I would like to start with the Euro USD. The chart we have in front of us is the daily, and it stretches back quite some time up to 2013. I squeezed in all that data. You can see that we are obviously at a point where the Euro USD is not quite in a trend. As you might suspect, there hasn't been a lot of time from the end of last year to refuel some Euro bearishness or even to reverse it. So we're waiting for some signals from various points, and the point of the conversation today really is trying to look forward to the 2016 year, taking into account the current situation, and we certainly have a potential here for a number of trends or even reversals. So let's begin with the Euro US dollar. So we are in a situation where a lot of people would say, well, this is going to bounce back. This big blue candle was the one that we saw back in the day that the ECB announced its quantitative easing prolongation. So they said they would continue the program further, but not actually expand its size. And from this day on, we saw this bounce from 105 to pretty much 110. It's this 500 pip range. And you see that we are at the moment trying to go back up towards that target, but there really doesn't seem to be a lot of strength in that, and we must at this point decide where we stand on the euro generally, because it certainly doesn't seem to be from where, depending on what kind of indicators you adopt and what kind of fundamentals you look at, there does not seem to be any strength in the euro, and certainly the troubles that euro is under have not disappeared, although some countries individually, in terms of GDP, may be performing better. Now, this is second-hand information. Please, you can go and on any website like Trading Economics or Investing, and even just a Google search, bring up the GDP for any European member country, or even for the Eurozone or the European Economic Area GDP, and see for yourselves, what you make of that in terms of relative performance, and relative also to the US dollar and the United States. Personally, as you can see from the volume here on the 3rd of December, this is the FXCM real volume indicator, which only pertains to retail volume, but even so, this volume has not really been, it was quite a unique occurrence, really. There was a lot of coiled up waiting for this event, so I think that sort of strength in volume is quite difficult to replicate on a daily basis. But having said that, if we look back a little bit, we see that where we are now is under the 5 billion, and we are towards this mark, which is 3 billion. So there is volume. That's true. But let's look at another indicator as well, which I like to put on. I don't like putting too many indicators, but I'll just keep the volume on at the moment. So add the ATR, which is the average true range. As you know, if you've been following me, I use this a fair bit. And you can see that if we squeeze a bit, now we are at 89 pips. This is an average over 14 trading days, so 2 trading weeks. And you can see that the euro has been quite choppy since this was April, well, really since almost March. Yeah, March of last year. We were at sort of 106, and we're now at 108.70. Let's say. Well, we're not really visually. You can see. I mean, it's a daily chart, so there's a bit of a distance between this and that, but visually you can see that we've not really made progress to the upside or to the downside. And so in a way, it's a sort of sideways almost. But look at what happened to the ATR. If you had an RSI here, doing this, you'd say that there was some kind of inverse correlation to, they said this was moving up. Well, it sort of is moving up from this end to that end, but it's not really. But the ATR certainly is showing that we have had a decline in average pip range. So we had, at this point here, we had a peak at about 200 pips and then down to 130, bounce back up, and now we're sort of under the 100 mark. So certainly we are, it's getting quieter on the euro-US dollar, and for the life of me, I know that there are a lot of people who love this pair because it's very liquid and stable. For the life of me, I cannot understand the appeal of it. Either it's too liquid to move anywhere, or the just fundamentals are too modeled for the euro side. I think the US dollar side is much more secure in terms of its direction, but certainly the euro side is very modeled, and I cannot see, at least short term, certainly there will be moves like, if you take today's move, you can see that it's a fairly strong candle. We opened up there, and so the size low was 107.71 and high so far 108.74. So we have almost 100 pips. But trying to capture all of that 100 pips from bottom to top is a rare skill. So essentially, you might have been able to capture maybe half of that or 3/4 of that. And absolutely fair play if you've done that, and I absolutely applaud you. But I think for long-term trading, like what I do, this is not really a pair that appeals to me in any way. So let's leave it behind if you don't mind, because I just really want to get on with discussing other pairs and other assets. Speaking of the US dollar, we see that the US dollar has been quite prominent in its rise. We've had, let's take it back to the beginning of the year. So this is Christmas Day, obviously no trading. 28th, we started up at about 12,088, and now we're at 12,200. Now we've banged against this 12,200. In fact, to make it really obvious, we put a line there. You'll see that we've had this level several times, and make it a little bit bigger, so that's better. Okay, now you can see that really, if we go back, it goes back all the way to the 6th of November. Okay, and because it goes back to the 6th of November, and it's been pushed against several times, today it's nothing new. Okay, but what is remarkable about this is that after this rise that we saw again back in November, we've not really had a rise like we've had in the last few days. That's 1, 2, 3, 6, 7 consecutive trading days to the upside for the US dollar, and so we started the week basically here. So 3 days to the upside. Now today's candle is very subdued. In fact, it might end up being a doji. We know that obviously the New York Stock Exchange session is starting later today, so we have to see what that brings. But certainly we are in a bit of a model here. So again, I use that word to indicate a situation of uncertainty. But the US dollar certainly is in a position of strength because it's pressing against this, and for the lovers of geometrical formations, you might want to say that this is, on a daily chart at least, it's a sort of triangle forming up. So if we extended that line, okay, it's not too precise, but just to give an indication of, you see that the triangle is obviously compressing this towards this resistance area or zone at 12,200. So eventually, as we all know, this will have to break either to the upside or the downside. Now obviously some of you might say, well, hang on a minute, the potential here to the downside is immense. So could there be a potential for the US dollar to the downside? Well, certainly there are a lot of pairs that could take advantage of that, such as the cable, i.e. the British pound US dollar. And you can see that we've come after a remarkable stretch of down days. In fact, short term, starting from about here, we've had which is back in June of 2015, we've had really almost a channel, and then we've even broken that. So it's been a precipitous descent to these levels here. 1.45 is roughly where we were in April 2015, and also 1.45 is there. We sort of came past it roughly in 2010, but then only down to 1.42 and then back up. So, and going beyond that, there isn't really that much at 145, so we don't want to go back too far, but certainly 1.45, you can see there are one or two interactions with that level here, but regardless of that, certainly 1.45 at the moment is lower than the levels here, 150 that we had back in 2013, these bounces, and but still higher than this level here in 2010. So you might say that we've come low enough to pick up a sort of buy opportunity long term, but we could go lower if you went by past history. There's certainly levels here and here. So as I said many times, the cable, certainly as a pair, I think it's very much a pair that you can look at long term in this 7-year cycle structure, where you have the potential of one side repeating on the right hand side with this middle swell. So you have a cycle with a wave, double the size wave, a wave of a similar size to the first wave, and then if you could continue this cycle in a similar way, then the next leg up might be something of a similar size to this. So this kind of cyclical aspect would suggest to somebody that I think that it could certainly be something that long term could play out very nicely, but I would be cautious to enter long at this point, given that the pound is falling so sharply. If you're in a long position already and you're happy to hold on to that, then if you can bear the risk, absolutely carry on, because at any time this might actually reverse. But it's quite hard to tell at the moment. There's not been really an uptrend in the pound for a very long time, certainly since the rate hike bet started in the summer 2013. That was the big attempt, and that when that fell through, the next attempt from this 145 to 159, 1,300 pips or more, that was obviously a good buying opportunity. But if you wanted something on this scale, then you would have been disappointed. And perhaps if you're still holding on from here, well, you haven't really made a loss, except perhaps any fees that you may be paying, but really it's a neutral kind of position. So you might just hold on to it if you've been long all this time. Some people hold on to trades for many months, so why not? Now, in terms of the volume, you can see that volume has been descending overall, and that is probably an indication of something. And I think that we certainly have the potential for an event. Now, what kind of event might get the pound to move and the volume with volume behind it, either in a selling sense or in a buying sense? I don't know. Nobody knows. There are, of course, indicators of strength for the UK economy. The usual GDPs, CPIs, PPIs, PMIs, services and construction. We have balance of trade. We have various announcements from the Bank of England, perhaps speeches, the Brexit referendum news. We have the UK floods, which are affecting the economy. We have the companies in the UK which are suffering because of the oil drop in price in oil. We have, there are a number of things obviously that can affect the pound and investment in sterling. So But those are considerations by the way. We're just looking at the technical picture of this, and there is nothing immediate that screams buy now. So technically you could buy now, but fundamentally nothing's changed for the Bank of England, and we'll have a Bank of England rate decision later this month. But we'll never say never, but obviously the probable shift that more than one member, McCafferty, will turn a hawk is quite slim. So let's leave that to the side and look at the other UK asset class, which is the Financial Times FTSE 100 shares index. So this, there have been several calls for people to just abandon this because it's been moving sideways for most of 2015, and in fact it's been negative. If we look at 2015 from a monthly chart, you'll see that the period from January, which is at the start of this chart here, that's January, opened up at this level, and we finished December here. So we've actually closed negative. That was the open, 6,550, and we closed December at 6,230. Okay, so about 320 pips down, or 320 points, I should say, points down. More than that, we've come down to this level, which is the 6,000 level. Now, this is quite an important level. Do I say that it's important? Yes, I do. Why? Because psychologically, it's a round number. Round numbers do play a part. And also, you can see how around this zone, I call it 6,000 because it's easy to remember. Certainly, this actually bounced up to 6,100 before coming down back in 2011. But certainly, let's call it 6,000 more or less. It's that level. We've had it here as well back in 1998. Lots of interaction along wicks here, denoting a strong supply level to sell. Okay, and here as well, bouncing off, and then back here as well before moving higher. So it is an important level, and certainly since crossing it back in 2013, we've been above it, and tried to break down below it in August during the Black Monday of the Chinese stock market crash, the first of several as we've seen this week. And then, so we tried to break this level several times. So December, we tried to break it. This month, though, if you look at where we are, it was quite early in the month, though. We don't know if this will turn into a blue candle, a bullish candle, or whether it will continue to stay below or even extend this this move. But certainly, this could turn either way. At the moment, certainly, we have broken 6,000, and it comes on the back of one strong move south in June. So June was a negative month. We had this 500 pips move. Then in 2 months later, we had this move. The real body didn't really go beyond this by the end of the month, but even so, that was 500 again. And then a few months later, fast forward to January, and it's looking like we might have certainly another 500 pip move down to 5,750. Now, this obviously has an impact on sterling, so it's connected in a way because British companies are, although the FTSE 100 is not really just British companies, the FTSE 250 is more about British stores and such like. But even the FTSE 100 has obviously a link to British industry. So mining and oil companies are strongly related to this. So, you know, jobs in the oil industry are going thin. In Scotland, for example, a lot of jobs have gone lost because of the North Sea shortages of not of oil but of money. You know, opening new oil fields is very expensive, and keeping up old infrastructures is also very expensive, and there isn't enough investment in new infrastructure because, again, money's short. So it's there was a Norwegian tycoon recently going on media saying that he's setting up a company to buy up old oil fields that that are the old rigs that are basically they've been closed down for scrap. So, and he's going to invest in new kind of developments through the money made from that scheme. So there are opportunities for some entrepreneurs in this kind of environment, but certainly companies that have relied on the oil boom are now in trouble. And certainly the index sometimes says has more influence than individual companies, and it has also a reciprocal influence, so that so individual companies might be doing well and be on the up, but as the index begins to move heavily down, those companies and the people who run those companies who are invested in the market somewhere will have to consider their position in terms of their shares and what to do. So nothing exists in a bubble. A single company, parts of this index at the moment, even if they're doing well, would be thinking about maybe their exposure and whatnot. So it was important for me to show you this because obviously the FTSE 100 has a relationship to the pound, which leads us to the next. If I just overlap so one more thing, and I'll be on to the next topic, which is the pound versus the Kiwi Dollar. So you can see this is the monthly chart. There is a correlation between the two. Sometimes it's a positive correlation, sometimes it's inverse, one up, one down, and again positive again, and then sometimes it's again you see the FTSE 100 falling and the pound falling as well. So the correlation is not always perfect and unilateral. Sometimes it's very changeable. So, but it's certainly worth seeing that the FTSE 100 and the pound US dollar have moved in sync overall in the direction of late. So it's also worth pointing out that the pound is really a currency that is used by many. There is a lot of money in the city. That's the square mile, the financial center of London. But in terms of the Eurozone, the fact that the Britain has not embraced the single currency, Britain does rely also not only on its dealings in terms of the city, but also in its dealings with its neighbors, and certainly the Eurozone or the European Economic Area, the EEA, is an important trading partner, and by trading I mean buying and selling of goods as well as financial trading. So let me bring up the chart of Euro Pound, if I may, because this is the I must reveal that I have an interest in this currency pair because I've been trading it for quite some time. Now, I did make videos before, and one of them, in fact, was an article where I proposed that there would be a massive upside from the Euro Pound. 2001 was the year that the single currency came to be, and this was sort of a wedge or triangle back here. And then when the single currency was introduced, there was a massive sort of upswell in the value of the euro from 0.60, what was it, 0.60 to 0.70. Okay, that's 1,000 pips, and then we stayed for a longer term wedge, and then coiled up, and at around 0.67 we shot up and then recoiled here. 2008 was mostly a consolidation year. Funnily enough, 7 years later, I subscribe to a theory of 7-year cycles. we have another sort of accumulation period or phase, and that was here in 2015. Okay, so 2015 was, that's February. Okay, so from about February 2015 to December, the euro pound was basically just stuck between 0.70 and 0.75. A 500 pip range for an entire year says it all, really. Although this is not a fast, big swinging currency, this consolidation is indicative of something that is going to change. I've made videos before where I prepare this particular chart with some lines, and we'd have a descending line just over here and a channel top here. Now we've broken that line and we've sort of receded back towards it and then just above it, but it's not really conclusive that A, the bear trend is over. This could move lower still, and it's not conclusive that this accumulation phase is one that will lead to higher highs. So in my previous video where I was advocating a big swell to the top, it was based on cycles and various measurements. I won't go into that now because it's quite a long operation, but certainly it was a probable theory, and no more appropriate than this timely moment where we are coiled up at these low numbers, which are historically relevant, because you can see this line at 70 has been a strong kind of resistance area, and once we broke above that, we've not returned to it, we've not returned below it, 0.70. Even in 2015 we pressed hard against it, but we're still stuck above it. So surprising resilience from the euro pound, which doesn't really speak true when you think about the difference in the strength of the economy of the two countries. Europe is not a country as such; it's a conglomeration of countries. But overall, the United Kingdom has been doing okay, and I just say okay because it's not been doing great. Of course, there are many problems here. Now, in terms of indicators, I'm going to add the real volume. And just to show you again what the retail volume is from the FXCM side, I always stress that it's the FXCM because, well, it's not sort of central volume like in stocks, so it's limited to this particular area of the market. You see, the 16th of November was a big day for this pair. There was a lot of volume there, but not a big move there. And we know that when the relationship between volume and price is so disparate, we should be cautious. So if people thought this was going to be, there was a gap down, and this was going to be a big move to the downside or the upside, well, nothing particularly happened. In fact, very small candle there compared to the volume. So for the next true move, we have to go up to the 3rd of December, which was the ECB rate decision. A lot of volume here, and an equivalent big move here in the euro pound. Now, this move was 0.72, 0.71, about 120.25, say 120 pips. Now, today we have 0.7365, 0.7465, about 100 pips thus far. Okay, so far in the European session, we've climbed 100 pips, and the volume is not particularly strong, but it's not shy, and it's just about 250 million units. Okay, so it's a respectable volume, and it's strong enough. I do apologize. It seems I was pointing at the wrong one. That was yesterday's volume. Yep. Today's volume is actually lower than yesterday, and the candle size compared to the volume size should make us cautious of this. So I'm completely changing what I was about to say because I just realized what I was saying. I'm quite flexible with the interpretation of this at the moment because on a day-to-day basis, I don't really see where this is going. There have been several attempts at coming back up to 0.75, one here in October, quite noticeable, and just end of December, beginning of January, we're here again. But will it break back here as well in May? Well, it hasn't so far, and I don't really see what's changed sort of fundamentally. Whether the order flow for not currencies per se, but of money flow towards the euro rather than towards the pound has changed, well, maybe the charts will tell a story there, but at the moment I don't really see the volume behind this move as one to break 0.75. And although the pound has been quite weak, which is probably why this has gone up, I don't really see fundamentally how this could continue higher, unless something went particularly pear-shaped with the British economy, or with pound selling, gaining even more strength. But we have to be cautious here. So this particular pair is one where I think the pound still has the upside, although of course a move to past 0.70, because it's a sort of historic level and has held for most of last year, will require a bit more strength and conviction from the pound side, or a lot more weakness from the euro side. This takes us to another pair, as I promised, which is the pound Kiwi. Now, I was quite a long time on this currency pair, the euro pound. So let's go to the pound Kiwi via the Kiwi US dollar. Why the Kiwi US dollar? Because we don't have volume figures for the pound Kiwi. So I want to show you just briefly the Kiwi dollar, because we have the volume bars, and now you can see that we have had volume that has sort of been declining. I'll put a line here just to show you it's not exact, obviously, but it has been declining, and there's no doubting that, even if we did it like this. And this declining volume is a combination of coming to the last quarter of the year, the end of the year being a thinner liquidity environment. It's not quite picked up yet past the 500 million. So there have been higher volumes here. Obviously, the 1 billion is a very high volume. So you see this overall chart and you think, oh, this is the norm and this is very low. Actually, these are the exceptions. Particularly strong days. This was Black Monday, so you can see, the Chinese market crash. Something of that scale will reward traders to the spectacle of piercing the 1 billion mark in terms of volume, at least on the retail side. But I'm sure it wasn't the only side that had a high volume on that day. And other peaks, probably the ECB rate decision was there. The 9th of December was the Kiwi Reserve Bank of New Zealand rate decision, so that was a high volume event, up nearly 900 million, so nearly 1 billion. So those kind of events will, but even so, the volume has declined. End of the year trading conditions. However, we have been playing for a few months now with this 0.67 level, which has acted as a resistance or supply, if you like, area, and then again we've interacted with it. But it's almost like a pivot area, swinging around this pole almost. And sort of yo-yoing. So in a way, between 0.65 and 0.69, 0.67 represents the middle ground. And in spite of this, if you only open the charts of Kiwi US dollar as, say, a day trader, and you had the day chart, or you were looking at 4-hour charts, well, you might see a good selling opportunity here from 0.6860 down to here, 0.66. That's quite a nice little move. So you would be probably right to make setups and trade these moves. But you can see that we bounced there towards the end of December, and but we now pierced through it again at the beginning of the trading year, and we stayed below it. So the question is, what is going on with the Kiwi? Well, certainly we have concerns. The last trading auction in Auckland was negative. So dairy prices have come down mostly because of the El Nino weather system and the impact it's had. After several years, this has been one of the most severe El Nino events, and it has laid bare parts of New Zealand, and so the pastures for agriculture have been also with water pumps have been shut down, so there's a ban on irrigation of fields, etc. So this is very difficult, obviously, for farmers and pastures for the cattle. The dairy industry is responsible for something like 30% of the GDP for New Zealand. So you can imagine this is a real impact, and this spreads to financial markets and the currency. So as less people buy, there is less, there's less appreciation of the currency. As less people buy from New Zealand in Kiwi dollars, the currency depreciates. It's a supply and demand, so there's nothing particularly groundbreaking about that. Certainly this drop has been quite consistent. It's a 6-day straight drop from 69 to 66. That's kind of 300 pips, which for this pair is quite a big move like that. And of course, this has influenced other trading pairs. So the pound Kiwi is the one that I want to show you. If you have been following my videos, you'll know that I have been long this pair for a very long time. In fact, 4.5 months since entering at those peaks at 2.46. So that was the Black Monday. See the exaggerated candle and then the retreat there, and then we compressed against that 2.45, really 2.45 level, and then down came this wave that some people describe as ABC correction wave. Okay, I'm not an expert in Elliott wave patterns or waves generally, so I'll leave that to the experts. But certainly that's what has been described on websites like poundsterlinglive.com, latest article calling this a correction phase. So, and this correction phase took a stall or a pause to catch its breath at 2.25. There was a lot of speculation among people, including myself, whether this was the end of this corrective phase at 2.35, so 1,000 pips up, and then it went back down, a little bit more of a pause, and then onto the next leg, another 1,000 pips down to 2.15. So we've recoiled back from 2.15, and the beginning of the year started on Monday with a nice strong move up, 3 days to the upside. Today it's been a bit of a nondescript day. We're sort of waiting for either continuation to the upside or perhaps not. You can see something similar to that, which is now everybody loves a good pattern, so I'll just satisfy your need for patterns, which is certainly among most of us. And you can see that there was a move of 4 consecutive trading days to the upside from 225 to 230 back here in October, 16th of October. We went up, and that was a 500 pip move there. Okay, and then that really didn't serve much of a function in the following few days until it picked up for the next leg up, and then a further 500 pips to 2.30. So we could see something like this where it needs a bit more time to build on that. So let's say that this was a down day and cancel most of that progress, and then it could continue to 2.25 again, and then maybe further up. There's been a lot of speculation as to whether this is a correction, whether this pattern, which is the bull trend from April of last year, has now officially ended and we're just going to retrace it all the way to the bottom. If we did, that would take us down to 1.95, okay, which is 2,000 pips and another 400. So a big move. If you were selling from here, good luck to you and absolutely correct. I think if this continued down, I might have to rethink my strategy, because long term I'm still long for this pair, so I wouldn't really want to come off now. It's too early to say. So the pound Kiwi has been doing this, and I was certainly of the opinion that this is a long-term channel to the downside, and we've come off the top here, Black Monday, and we bounced off, and there would be more room to continue all the way down to 1.75 and beyond, and before bouncing back up. That would be a very long play. Within that, as you can see, the previous bounce, I'll make it a bit more obvious for you. I had this drawn out before, and I think I've somehow lost all the lines. So I'll do them again. There's one, more or less. Okay, and then the next one would be the bottom of that. Okay, I'll just adjust these in a second, but kind of roughly you can see what I'm trying to describe here, which is a channel. Okay, now you can be quite particular, but long term we're not looking for precise entries. I'm just trying to illustrate something here, which is kind of visually easier to see with trend lines. Here we go. So you can see this this channel, and when we bounced on Black Monday here, okay, the bounce, just zoom back a little bit. Okay, the bounce took us down to, just make it a bit more obvious. Okay, that was a bounce. We came to or nearly 3,000. I do beg your pardon. That was back in 2008. Okay, wrong example. But anyway, let's use it because we're looking at this channel bounce. So 2008. Okay, we bounced off it, and then we had a period. So the close here was a 2.87. Okay, let's say 290. So 290 was the resistance level, and it took a while for this to go back down. Okay, and came back up to 285. Next time went down further, 2.45, all the way back up to 2.85. Okay, so there was a lot of time that it took from 2008 to 2009 to really move away from that, and then eventually we came back down, and 250 again, consolidation. This was 2009, most of it spent consolidating there. So from April to July. What I'm trying to say is that it took a while for this to go from this 3,000 pip area to the bottom of that channel. Okay, so if we looked at this from where we are now, it will take a while to get from 2.46 or 2.45 to 2.15. That's a 3,000 pip area again. It would take a while perhaps for this to move down to the next leg, eventually to the bottom of that channel, which is, as I said, down below these regions, and we can make that, extend it. It'll be something like 150 or so. So the future is uncertain in terms of the pound Kiwi. We're hanging in the balance, waiting to see what the pound will do, and obviously relying on the weakness of the Kiwi, which at the moment seems unstoppable. And that's really where we are with this pair. Certainly, I'd like to continue, but we are coming to 45 minutes nearly. So I would like to mention US oil. We've come a long way from these highs at 110 in the middle of 2014, and we had a bounce back up here in the middle of 2015, and now inexorably we are plunging to unforeseen depths, even lower than this lower 2009. So certainly we are seeing an extreme move, and nobody knows when it will stop. There was a sign that this was halting back here in August, and I did, I think, go long at some point here, and I made some pips, but it has to be said that I was right to get out in that particular situation. A, because I'm not really an oil trader, so it was really a I wanted it for the long term, but I didn't understand when it didn't what to do with it, so I came out with some pips and left it at that. It would be a good buy long term, obviously, based merely on the fact that through demand and supply and cycles, this has rinsed another high, an expensive set of prices back down to here. Now, it's not the same level as that, but it's close. And what happened here was that back in 2009, as I said, after the great financial crisis, we came down to these levels. And at the beginning of 2009, in fact, it's almost to the day, we had, here we go, that's the beginning of 2009. We have it the 1st of January, 2nd of January, 5th of January, so that would have been the first trading day after New Year's. It tried to sort of break down below 40 again. Long wicks coming down to 40, bounced back, and then from there on. So at the beginning of the year, it was trying to move away from 45, and then came back down one more time to 40, almost broke it, but only short term, and then the next period up came. But that period up really from 45 or from 50 at the beginning of the year didn't come until April, in fact May. So that's 5 months potentially of waiting for something equivalent in the current price range, which means that if you went long now, you would have to potentially have a lot of patient attitude to see this really build to the upside. But nothing repeats the same, so this could pick up quicker than the last time, and we don't know for sure what will happen. But here we are. That's where the US oil is, and the plunge obviously has affected a number of currencies, including, and not exclusively, but especially the oil exporting country that is Canada, with the CAD having taken a hit on many levels, many fronts. So if I pulled up a chart of, and incidentally, oil has not influenced the Kiwi as much as the Canadian dollar, because the Kiwi is more reliant on dairy as a commodity. So if we pulled up the CAD yen, for example, and we'll see that there is actually a correlation between this and the Kiwi yen. And I'll show both of them to you because they do have a correlation to the general risk sentiment that is in the yen crosses. So I'll just give you both on the same chart and you'll be able to see. So the thin blue line is the overlapped chart of the Kiwi yen, light blue, and the candlesticks are the ones for CAD yen. You can see that lately, this is a daily chart, they were doing similar things back in the latter part of 2015, and then a bit of consolidation towards November, December. December, the Kiwi yen was picking up. In fact, it sort of went through this 93 and up to 95, almost 96, and tried to stay up there. The Canadian dollar didn't do much at all, really. Very short, narrow trading range. And then started dropping with the oil scares towards the, in December. The Kiwi dollar wasn't too concerned with that, so it stayed afloat. And so the CAD yen started its own move based on oil. And if I put one more chart overlay, that would be the US oil, crude oil, WTI. So let's put it in a separate area. Now, this is the oil chart. You can see it started coming down here in October. Canadian dollar was moving with it, back up. Okay. Now, we're not talking about the yen here, because obviously the yen comes into this equation. I'm just looking at the CAD part of the CAD yen. But even so, the Japanese yen has been quite neutral around this time. And really, you can see that it was a CAD that was moving this pair. So the CAD, the oil started dropping from 50 odd to 40. It's quite a strong move, and the CAD was thinking about it at this point, and then it started moving south in December. Oil dropped more to 35, and at this point, CAD was down. Now, I haven't been following the Canadian central bank rate decisions, etc. I know that that is an important part of currencies pricing. So I'm just really following this one side of the story, which is oil. So you can see that with oil continuing its move south past 35 with some strength, the Canadian dollar has finally given up the ghost and is really taking an extra leg down with quite some force, really. That's, we're nearly at 83, and this is 87. So that's 400 pips in the matter of 4 days. That's quite a sharp move. And you can see that the Kiwi yen has also taken a move south. Now that was due to the as I said, the dairy auction in New Zealand, which showed a negative result. That was on Tuesday this week. It could be that. So oil influences the CAD yen, dairy influences the Kiwi yen. But if we removed this area, let's take this area off for a moment, and I'm going to add another yen cross, which is the major currency, and that's the US dollar, Japanese yen. So let me put that on the screen, and now we can see another pattern emerging, which is one that one of the people that I follow on Twitter and DailyFX, the chief strategist John Kicklighter, really has been talking about for a long time. In fact, probably ever since I started following him about 2 years ago, and that is risk aversion. With levels in the stock market at record highs, we certainly have this potential threat that this aversion to risk exposure is going to come in a way that all asset classes, whether it's equities, stocks, currencies, anything that is exposed to the market at current levels, commodities as well, will come down almost unilaterally, and you'll see this correlation, this positive correlation between different asset classes all moving in the same direction. One thing that generally speaks to that theme is when different currency pairs align, and the Japanese yen has been appreciating recently. Part of the story is the Bank of Japan has really, at the last rate decision, announced that it is no longer going to try expanding its asset buying program. It's been making noises really to communicate to the world and the markets, especially, that it does not intend to prop up the system any further. And this will allow the yen to appreciate, and they're not going to stand in its way. So combine that with what these currency pairs have generally symbolized and stood for, which is it's the carry trade, when the Japanese yen was pursuing its QE, or quantitative easing program, of printing money, essentially, or bond buying program. In the last few years, this propped up currency pairs like the dollar yen. You can see quite clearly on the daily chart that from the 2011 lows, since the QE program started, 2012, it went up quite considerably, and the next leg, 2014, of the QE program went up. So these moves are partially due to the US dollar, but also quite a lot due to the Japanese yen. And you can see from the shape of these curves that really all three currency pairs that we have on the screen, that's the Kiwi yen in light blue, underneath it is the CAD yen, and then down here the dollar yen you can see that they've all moved up to the same theme. That can't be a coincidence. You know, if this were only due to the US dollar, then why did the Canadian and the Kiwi move at the same time with the same sharpness to the upside? Obviously, this was due to the QE program, which made the Japanese yen cheap to fund a carry trade, gathering swap on interest over a long period of time. So buying hold either of these currencies would have earned you interest. As the interest rate differentials started to diminish, and also as the QE program started to be starts to come to an end, essentially, or at least not expanding to new highs. There's a difference between cutting or tightening and not enlarging the size of the QE program, as we saw with the ECB. They're still pursuing QE, but not to the extent that the market would like it to, and therefore the Japanese yen has appreciated sufficiently enough for the carry trade to beginning to look a little bit overpriced. And so we've seen, as you can gauge from the end of these charts, where we are now, the Kiwi yen is depreciating, and the CAD yen is depreciating, and the dollar yen is depreciating. Now there are other yen crosses as well, but I'm just going to stop there because that illustrates that it cannot just be a coincidence that, okay, you could say that the Kiwi is depreciating because of the dairy trade results. You could say the CAD yen is depreciating because of oil. And all of those things are true. But why is the US dollar depreciating against the yen, for example, when in fact the US dollar is quite buoyant at the moment, as you can see? It's pushing up against that all-time high, 12,200. So it's not really showing a sign of coming down on the daily chart. And therefore, that makes you really appreciate that the same currency, the US dollar, is doing different things. And this is because the carry theme, the carry trade theme is essentially unwinding or deleveraging, as it's known. And I think there is a sign here for all to see that when all the yen crosses align in this way, we're in for a period of selling off, essentially. Now, some currencies like the CAD yen are going at it more aggressively. The Kiwi yen is a little bit more cautious, and the dollar yen has a bit more resistance, or sorry, support rather, at this level, 117.18. But they all have the potential to go down quite a long way to the downside. So the CAD yen, for example, is at 83, but if you saw this as your target, say 73, that's 1,000 pips. Now, 1,000 pips is, you know, it's a fair drop. So it's not as big a potential as the dollar yen, which would be a massive move worth, you know, 2,000, 3,000, 4,000 pips potentially. And the Kiwi yen as well would be still a little bit more overpriced than the CAD yen, but you know, all these have a theme which is unwinding, and that could be happening almost in sync, and obviously with differing speeds, but overall the direction is to the downside at this point. If we see that the FTSE 100 is going down, the S&P 500 has dropped considerably and past the 2000 level, which is a strong demand or at least support area. We've seen the FTSE 100. We haven't talked about other asset classes, other indexes like the, let's take another one, like the DAX, the German DAX, or the Japanese index, the Nikkei 225. This has been dropping like a rocket. So all of these have one shared theme, which is it's a market that's turning into a bear market, or at least it's not continuing a bull run. So if the indexes are going down, that's they're representing the stocks of many companies all over the world, Japan, and companies that invest in Japan, the United Kingdom, and companies that invest in the United Kingdom, United States, and so on. So these are big market players, and these indexes have a lot of money on them. So once that money starts moving south, it's a chain reaction. And I don't want to say the wrong thing here, but it doesn't take an economist to figure out what to do. You get out. If you've been buying and holding an index up to these highs and it starts doing this, you get out. Just like you would do for any other thing like commodities, oil, or currencies. So at this point, I'm really to the end of my video, and the message is we're at the beginning of the year, and there was an article recently on Forbes and also an article by I think it was Kathy Lien from BK Asset Management, and various articles I've seen on the internet where they were looking at results of the S&P 500 over the years, and they were looking at January of the years that they sampled, and it shows, and there was an article in Forbes magazine as well, and it shows that negative years for the S&P 500 overall are years where January is a down month, with variations and with exceptions, but as a majority over several years of sampling, the down months, the down years relate to a down January. So the S&P 500 is a sort of gauge for sentiment, if you like, for the US financial markets. You could apply that in the UK to the FTSE 100, and in Japan to Nikkei 225. You could look at yen crosses and see how this month, the way it's shaping up, which is to the downside, could have an influence over the entire year. Obviously, the market will go up and down. It won't be a straight line, but it pays to pay attention at this point. And I would think that the themes at the moment seem to be shaping up with an uncertain euro, certainly not a bullish euro, but an uncertain euro, possibly a bearish euro, a strong US dollar. But again, there are concerns here because of these levels, but this is a trade weighted index, so it's reliant on really other pairs. So it takes in the US dollar, a basket of currencies, the Japanese, the dollar yen, the pound dollar, an Aussie dollar, I think, and so on. So it puts all that information together and gives an index just for the dollar. But really, the euro US dollar has a strong influence, a strong bearing on this. So you can overlay this chart versus several pairs and see which one maybe it's the most influential at the moment for this up move. Certainly, with the dollar being strong, the euro will be pushed to the downside if the dollar makes a move above to 12,200 and it continues up, and this becomes a support area. Then currencies like the Kiwi US dollar are, ripe for the next leg down, okay, which would be down to these levels. We've seen the pound dollar still has potential to the downside, although it's certainly come a long way, okay, long term, but it could still move further down a little bit. And then it could even have a counterintuitive move where the dollar is moving up and the pound is moving up, depending on what the Bank of England will do through the year in terms of rate hikes. In which case you wouldn't want to play that theme because it would contradict. It would be like two things negating each other, and so on. So the US dollar is looking strong at the moment, at the beginning of this trading month of this new trading year. The Kiwi is looking weak, the pound is looking weak, the euro is looking uncertain, but certainly doesn't seem to have a lot of strength behind it, except on the back of the dollar being a little bit unsure of itself, bringing to the next new high. And there are other correlations. As I said, the yen crosses are a good opportunity to the downside. If risk sentiment is a risk off or risk aversion scenario, all of these and like US oil, other commodities will depreciate. Some of the commodities like precious metals at the moment, because of the oil plunge, have been appreciating, and certainly they go through their own cycles. And somebody on Power Trading Radio talked about recently the cycles of gold. That's going over many years of trading data. But if you see, gold has been appreciating quite a lot, in fact, and that's because of the oil plunge. Money flights to safety, and so a solid, palpable asset like gold, which holds its value as other commodities do, has been appreciating. But as you can see, it's been appreciating through a very long-term downtrend, so I would be cautious to just buy and hold. And certainly there is more room to the downside, like other assets, back to the 2008 pre-crisis levels, where gold appreciated enormously, and further up. So to summarize, it's certainly markets are always lacking certainty, but in terms of a bullish sentiment in the markets, by which I don't mean particular currencies, but I mean asset classes of various kinds that have been previously bullish, like oil, like indexes, equities. These are all taking a turn, and it's been a turn long in the making, because 2015 saw a very long period of stalling for again the S&P 500, but also the FTSE 100 and maybe other indexes. But those two alone tell a story of a market that is ready to turn and just waiting for something, whether it's just a turn in sentiment or a particular event that sparks concerns. Markets are huge entities. They're not single people that we trade against. As John Leiter once remarked, we don't play against the market like you would play an opponent in a tennis court. There are many factors, and it's sometimes beyond our knowledge to speculate which particular factor will influence the markets. Like the crisis, the great financial crisis, was not something that people had, or people in places of authority had predicted, saying that the housing market was strong, the economy was strong, the financial markets were stable, and then you saw what happened. And all because of the bad toxic mortgages that were being lent out to people who shouldn't have been given mortgages in the first place for housing needs. So when this turn in the market will actually take place, it may be beyond a particular event or news or war. It may be something that actually happens because all markets, wherever they're from, think with one thought, which is sell. And when that happens, it will not just stay restrained to a particular asset class like equities, or instrument like this particular one, Japanese equities. It will spread throughout. So any currency type like yen crosses, which is exposed to that risky positioning in the pursuit of yield, will deleverage and will come down pretty quickly with other asset classes in tandem. So keep your eyes peeled. There are opportunities to the short side as well as to the upside, but certainly I would keep my wits about, because when something like this happens at the beginning of the year, when the markets are just getting out of bed from the Christmas snow, then you know that something is afoot. And because of what's gone on in 2015 and the further shocks we've seen this week from China and its stock market troubles, I think we are going to see more of that. But that again is what I think. It may not happen, so we just have to take everything with a pinch of salt. So that's my disclaimer there right at the end of the video. But just to say, obviously trade carefully and set your targets, and whether you use stops or not, mental or physical, you decide, but certainly don't blow your accounts if you can help it, and try to trade for the long term. So stay safe and happy 2016. I hope it's a good trading year. Happy trading, and I will see you in the next trading video.